TheoTrade. This is Don Kaufman. It's January 10th, 2020, and you are watching the TheoTrade Weekend Update. A tumultuous ride this week inside of the broader marketplace. Ironically, most of the large moves that happened, however, in the market were in the overnight, or what we term Globex trading session. That's specific, of course, to our futures contracts. Nevertheless, you have to ask the question this week, what continues to drive this marketplace? And that's exactly what we're going to do here in the next 15 to 20 minutes, is discuss, again, a little bit more of the macro picture of the marketplace. But first, again, just a brief recap of some of the action that we saw on this week. As I said moments ago, a lot of the trade this past week, it happened in the overnight session. I mean, this is actually on Tuesday night. Of course, it looks like Wednesday here, but it's on Tuesday night. The after-hour session inside of the S&P futures marketplace, we sold off big, all the way down to the 3180, only to see us rip, to the upside from there and literally tag the upside of what is often termed expected move. Now, I'll quantify the expected moves as we go on here a bit, but just for a quick glance, the next time you may think that these expected moves don't necessarily pertain to you, that you have some position that is not impacted by the expected move, think again. If you take a look, what I'm using right now is the S&P futures. Now, the futures have options on those futures, and those options determine these expected moves. Effectively, what am I showing you here? You know what? The week on a whole, Monday, not much. Tuesday, almost no trading. Obviously, Tuesday evening, we dipped down, literally hit the edge of the expected move, ripped off of it, touched the upper edge of the expected move, and pulled in very slightly thereafter. People, we're going to talk extensively in just a few minutes here about these expected moves, because they're driving a lot of this marketplace. Already foreshadowing here on, what is really one of the drivers behind this. So today, here on Friday, the S&Ps are going to close down about 11 handles. Nothing to see here. There is one aspect that I want to bring to your attention, albeit briefly. There has been some a spike in volume, obviously, with some of the geopolitical risk on the horizon. But even today, which is Friday afternoon, a bit of a spike in volume on the S&Ps. It's worth noting because as this day progressed on an intraday basis and late in the trading session, there was some decent hedging activity that actually sparked back to the last hour of trade, and something worth keeping an eye on as we move, of course, into early next week. So now we're just going to jump directly into it. I'll talk about a couple of different sectors here as we move onward and upward. But I want to jump into it in really a larger sense. Hey, what continues to really drive this marketplace? I mean, day in and day out, it feels like, it's Groundhog's Day, right? And every day is an up day. It's a happy land is here again. But you're starting to obviously feel a little bit of a euphoria. And that is, I was even standing in line the other day for a cup of coffee. I use it as what I call like my Starbucks indicator. There were people talking about the market. I was in the gym the other day, and people were talking about the broader market. Nothing can stop it. It's impenetrable. But let's get down to it. What's really driving it? All right. We could actually point towards the Fed balance sheet, repo market, low interest rates, and negative interest rate policy. So I can make some strong arguments that the Fed balance sheet, is driving a little of this marketplace. In fact, in this case, I'm going to pull up the spiders, and I want to back out for about 10 years. So the Fed pretty much has been on the accelerator for the last 10 years, or have they? All right. So one of the first things that I want to bring to your attention here regarding this Fed balance sheet is, well, the best way to talk about the Fed balance sheet is to actually look at it. In fact, I'm going to back up the time frame very similarly to the chart that you just saw a moment ago on my screen. And the chart you saw a moment ago on my screen was just the spiders, right? I mean, come on, the spiders, what are they? they're a straight line to the upside. So if you believed the Fed balance sheet, in fact, the expansion of the Fed balance sheet is driving everything, well, there's some things that are not easily explained. First of all, here we are in 2010 coming out of the financial crisis. We're ripping out of the financial crisis. Yeah, it's because the Fed was on the accelerator. But the Fed largely did absolutely nothing from roughly 2014 until 2018. And in 2018, they actually started to decrease the balance sheet, until which time everybody had a little bit of a tantrum, right? If you looked at October, November, and December of 18, everybody freaked out, and the Fed went back on the bid. So 2019 saw when the Fed actually flipped around, and I'll zoom into that for just a second. The point that I'm making with this is, if you're a believer that the Fed balance sheet alone is the driver, of the marketplace, and, how then do you describe that the Fed really didn't do anything from 2014 until, 2018 when they started contracting the balance sheet, and all of the volatility from contracting the balance sheet, can be found right here. And when I say right here, that's it. that was the contraction of the balance sheet, and all of a sudden the Fed's back on the bid. But I think it's a weak argument at best that it's all about the balance sheet in this particular case. And we're going to continue from that point forward. So now the Fed is actually expanding the balance sheet again, as I showed a moment ago, and they're involved in the repo market. I get it. I would put, though, much more and significant weight into low interest rates and negative interest rate policy. And I'm going to describe that as we move forward a little bit here momentarily, is that, again, I would put more weight behind not the expansion so much of the Fed balance sheet, It's this right here. Low rates and negative interest rate policy. I'll give you a 2-second synopsis. With low interest rates, obviously it would allow firms to go out and to do things like, monumental stock buybacks through debt offerings. So even a company like Apple, and Apple, they got a lot of money on their hands, right? So Apple turns around there and does debt offerings. Why not? What are you going to pay? 3.5% interest on it. They do debt offerings, then turn around and buy back their own stock. You can see I'll cover stock buybacks here in a moment. Or negative interest rate policy. Negative interest rate policy actually allows companies, and again, I'll use the marquee, which is Apple. It allows companies like Apple, they'll do debt offerings, and they'll actually, for the most part, borrow capital in other countries. Could be a country with negative interest rate policy, could be a country that basically has a bond buying program like anywhere in Europe, and they'll then turn around and buy back stock. Again, low interest rates, the implications are so many-fold, although there's one key event that we'll talk about with low interest rates here a little bit later. So again, I am less inclined to blame the Fed balance sheet. I'm more, inclined, and I'm not so much into the repo. The repo market isn't necessarily going to find its way into the S&P 500. The repo market, however, it kind of makes you just feel the Fed, they got your back, baby. All right. It's all about low rates and negative interest rate policy to me at this point in time. Now, next, earnings. Now, here's an interesting one. Earnings aren't exactly what you would think they are. This is actually, when I say what drives this market, this is not so much a bullish, sign of this. Here we are looking at a little bit of a bearish sign, in the broader markets, because this is a big article that happened to come out effectively, yesterday. Today's January 10th. This is January 9th. Nearly all corporate CFOs say the economy is going to slow and the stock market is overvalued. Now, granted, we are hearing from a number of bean counters here, all right? So I take this with a little bit of grain of salt, but I wanted you guys to know that because the CFOs, they have their finger on the trigger specifically for those stock buybacks. So what is one of the key drivers of the marketplace? Let me give you a cautionary tale here. It may not be earnings, Earnings are going to come, and they start this next week. I mean, we even saw like some earnings from a few home builders and so forth. Mixed bag of goods. I think KB Homes came out. They missed, and then the stock rallied up a little bit. Nevertheless, the point that I'm making with this is like earnings, they may hinder, what officially drives this marketplace. I'll continue back to that though a little bit later here. Next on the docket over here. Well, we're still driving higher, and yet there's geopolitical instability. All right, if you don't believe that one, you only have to look back at a little earlier this week with a wild, that was a range of over 2% on the trading session from low to high. And we literally hit 3180 all the way up to roughly 3270 inside of trading session. And are we through it? Are we through the geopolitical uncertainty? Markets, okay, they're pricing zero event risk ahead. There's no event risk being priced in. And even if there is, like, it doesn't matter what you think geopolitically. Again, I don't mean to be dismissive with that, but it doesn't matter what you think geopolitically. You want to know why? Because the market thinks absolutely nothing of it. If the marketplace saw risk, don't you think they'd price it in over here? I mean, look at this. 6% vol, 8%, 10%, 10%, 9%, 9%. It's ridiculously low implied volatility. But in the back month over here, there's still a fairly heavy skew in the back month vol. It kind of picked those little monkeys up at the 15%. So volatility, roughly speaking, in the S&Ps, and it's important to know the S&Ps, this is the game that runs it, right? In these S&Ps, this volatility is roughly what? It's 50% greater than it is, like 10 days out. That's an important concept over here. So geopolitical risk doesn't matter what we think. Okay, it matters right now. The marketplace is pricing zero event risk. I don't necessarily agree with that. I'm just telling you what I see on the screen. I actually believe there absolutely is, okay, unequivocally some event risk, and it makes me want to be a buyer, a net buyer of options. So as we look at this, what continues to drive the marketplace? You got low interest rate policy, but at the same time, CFOs are warning, and they're the ones who actually do the stock buybacks. We probably have a degree of event risk. So you're starting to see that the marketplace doesn't necessarily gel with what you're seeing, okay, in the economics behind it, in the geopolitical, all right? What I'm trying to get you to see is it just doesn't make a difference, okay? What a CFO says. It doesn't make a difference what the geopolitical situation happens to be. And I'm getting to exactly why. The next in the docket over here, got the macroeconomic picture. GDP, jobs numbers, they came out today. Not as good. We've had some good numbers, some not so good numbers, mixed bag of goods. Hey, listen, 145,000 jobs can't be wrong. CPI, though, and PMI lately have actually been also a mixed bag of goods. You can make some arguments that, some of those numbers are still very close to contraction. And when you start looking at, an economy like Germany, maybe they bottomed out, maybe they didn't, but they are still in contraction territory. So is China. Okay, the global picture, though, isn't per se great. So I think you could look at that as a double-edged sword. Global picture isn't that great. Maybe it's going to get better. I get it. Like, people can make a pretty good argument for that one. Low interest rates, eventually it's going to help. Okay, but I'll push that aside for right now. What also continues to drive this marketplace? Stock buybacks. All right, so this one, to me, no doubt, stock buybacks are driving order flow to the upside. There is that. That's without unequivocation. Again, I'll hammer that all day long. Now, I have one symbol down below over here that I wanted to bring up because you have to start to question stock buybacks a little bit. Here happens to be Bed Bath & Beyond. Now, Bed Bath & Beyond, okay, they've had a couple of announcements throughout recent weeks. One of their announcements, and it was, again, before the earnings, was, let me simplify this. They went out and they actually sold some of the real estate holdings, like actual physical assets that they owned. They sold some of the real estate holdings, about $250 million worth of real estate holdings. And they were going to go out and do a couple of things with the money. One of those happened to be stock buybacks. I go, okay, wait. So we believe our own crap so much that we're actually selling physical assets to buy back our own crap, which is their stock? And the answer is yes. And that's when you start to look at stock buybacks, right? Although they are absolutely unequivocally helping drive this marketplace, okay, they're also possibly one of the biggest areas of risk because there's exploding debt. Why? Low interest rate policy. Okay, you got low interest rates, you got negative interest rate policy, of course. It's basically going to allow, and I'll say this in the nicest possible terms, degenerate borrowers to go out there and to survive, okay, in the marketplace. And this goes even further than just degenerate borrowers. You got to look at companies like, I'll just give you a quick example, Tesla. It doesn't matter what you think about Tesla, okay? I'm going to tell you something definitive, though. Tesla could never have built this company, and again, everybody thinks it's Elon Musk, there are other founders of the company, but Tesla never could have been built in a higher interest rate environment. They're effectively junk debt status, and yet their interest rates are incredibly, incredibly low. So question what you will. This week, they actually hit the largest market cap of any automaker ever, if you consider them an auto manufacturer. I consider it I'm driving on a battery backup with wheels. That's what it is. Anyway, stock buybacks unequivocally driving the markets a little bit higher. But what really drives the market? And again, this is what I wanted to lean into heavily. It's the quants. Okay? The quants have full control of this marketplace. Look no further than the SPX. Now, I did an example of this, okay, briefly on TheoTrade chat throughout the course of, well, today's trading session. I'm going to lean into it a little bit more, okay? We are now seeing 23 weeks, 23 straight weeks inside what we term these expected moves. And what's really driving the marketplace, it's a number of what we term quantitative strategies. Now, some people just have no clue, like, well, what is a quant? Think of a quant, it's just a downright math geek, okay? But quants are trading for reasons, okay, that, I mean, I grew up in that world, but generally speaking, for reasons outside what you or I could even fathom. Statistical arbitrage, volatility arbitrage, okay? I mean, long-short strategies, premium selling using dynamic hedges. I could go on for hours about all the different quantitative type strategies that might be available out there. I mean, there are literally, okay, tens of millions of quantitative models running in this market right now. And what I want you to know about quantitative trading, or, you know, what they call the quants. First of all, okay, I almost will guarantee when this marketplace does eventually come down and comes down hard, they're going to point the finger this time, people, and they're going to point it right there at those quants. There's no question about it, though, that quants are driving this order flow. Here's the bottom line. It doesn't necessarily matter, okay, how you get edge or how you generate degrees of profitability. The example that I'll give you is this, okay? You have a quantitative firm. They go out and they find an edge in the marketplace, and that edge can generate returns. I'm going to do something crazy. I'm going to say it like 3%, which is so negligible, right? They find something, these quants find something they can make 3% on. And yet they can turn around, though, and they can borrow capital at 2%. And you're like, oh, there's an edge in there, right? They borrow the capital at 2%. And by the time they make, 3% and they've got 1% edge, yeah, you missed something. They take that 3%, then they go into the derivative market and they amplify it. Okay, amplifying returns is critical. You can turn that 3% very easily, okay, into 20%. They're borrowing the capital at 2% now to turn around and make, for instance, tenfold sometimes on their capital. So add another zero, to this over here where you're making like 18+% on a given strategy. It's all about that edge and the fact, though, that they can carry these edges in a low interest rate environment. This wouldn't necessarily exist if the rates started to go up, which they absolutely do not appear to be doing anytime soon. So the quants are using heavy amount of derivatives in effect to do this, which makes, okay, their hedges a lot faster and a lot more sketchy. I'm going to show you, okay, one very, very simple quantitative strategy, but this quantitative strategy is moving markets right now, and I'm going to display this to you in the SPX. I'm going to make this as simple and as clean as fast as I possibly can. The first thing in the SPX that you have to understand, okay, the SPX today did 1.5 million contracts, right? Just remember that. The spiders today, okay, we're going to cruise over to the spiders here. Spiders traded, let's just round it to 3.5, okay? So, well, let's also pull up the VIX. Let's have some fun. Pull up the VIX as well, okay? Because the VIX is interrelated, right? So if you looked at the VIX and the spiders and the SPX, it's all one and the same animal. The VIX is good for another 500,000. So what do you got, all right? What do you got in this particular case? And again, just to show you that this, okay, this kind of trading activity, right, here in like the spiders, this is the norm, 3.4, 3.5. So start to actually add some of this up. And again, the SPX is good for 1.5 million contracts. The spiders are good for 3.5 million contracts. The VIX is good for 0.5 million contracts. It's a party, people, because all three of these things are directly related to the SPX. The spiders are related to it. The VIX is related to it. It's a party. They're all the exact same animal. Before you know it, you start to add this up. I just want to be very, simple in this. Let's just say that every day about 5 million contracts are traded in options that directly relate to the S&Ps, right? I'm just rounding it over here, 5 million contracts. But net, the entire marketplace only does, 20 million contracts in a given day. 5 million of those, though, are specific to the S&Ps. There's a lot more than 5 million, but I want to also remind you that if you look at something like the SPX, this SPX contract is a magnitude 10 times greater than almost any other contract out there. Why? Because the SPX is a $3,200 product. You compare that to Apple. Apple's a $300 product, right? It's magnitude of 10 times. So instead of looking at this as 1.5 million contracts, you should be looking at this as a magnitude of what? It's the equivalency of like 15 million contracts. When it comes down to it, the S&Ps, they're trading now 60-70% of all the notional value that goes through the marketplace is related to the S&Ps, And it's possibly even higher than that. It's difficult to calculate that. So what you're actually getting in this huge contract size that trades through the SPX, this 1.5 million contracts, you're getting traders that are just selling premium blindly every single week. Just look at the volume and open interest in here, Volume, open interest, all right, in terms of like the 1 week. And by the way, this next week, it's broken up into AM and PM settlements, but there's just monumental volume and open interest in here. 12,000 contracts trade, 12,000, of a $3,200 product. Do you realize the notional value in that? We're talking, again, all these trades calculated together, this is hundreds of millions of dollars, including all the open interest. We're talking billions and billions of dollars. So what happens is billions of dollars, rest on one number. It's the expected move. The expected move this week is about $38. And what occurs is all the hedging activity occurs in and around the $38 move. On a week-to-week basis, what we're actually seeing is marketplaces literally driven by the edge of the expected move. Doesn't matter, again, what you think. This is 23 weeks in a row. 23 weeks in a row, that we're trading inside the expected move. And I was pointing this out a lot in recent weeks, but, do you recognize, look at this. We closed basically a hair off the expected move. Right? The previous week, it was a holiday week. Well, we threatened down here, but didn't quite hit it. The week before that, hit the upper edge of the expected move. Week before that, on the edge of the expected move. Week before that, tagged it and pulled in. Week before that, we were actually through the downside, rode the edge of the expected move, rode the edge of the expected move. It just goes on and on and on and on. And on. It's just week after week after week. We just keep riding edges of the expected moves. People are asking what's driving the market. It's gamma. It's order flow. You get everybody basically doing the exact same crap, and it just keeps driving the market a little bit higher. Why? Because what occurs, is a hedge. And the hedge for the SPX is turning around and using S&P futures. They have to buy S&P futures to hedge, some of the negative delta that they're basically getting because they're out there and they're short options predominantly inside of, weekly based options. I said something years ago, and it was that these weeklies, this Monday, this Wednesday, and this Friday weeklies, I said they probably changed the nature of the market. But we won't know that for years. But now we say that without hesitation. The product itself, because they have Monday, Wednesday, and Friday expirations, it changed the markets. So the next time somebody says, hey, what keeps driving this market higher? Well, clearly it's not about earnings, because most CFOs don't think it's going well. Low interest rates play a key role. It's not repos, it's not the Fed balance sheet. Low interest rates, negative interest rate policy play a key role because they allow, the quants to operate. Stock buybacks also play a key role because the stock buybacks, in effect can start, the buying cycle, right? If you go out there and you buy a bunch of Apple stock, You buy a bunch of Apple stock, guess what? It starts moving the S&P 500 higher. And if you start to move the S&P 500 higher, you know what occurs? A trading firm then has to turn around and buy S&Ps. Why? Because they're actually what? They're dynamically hedging their position. That's what drives the markets in today's marketplace. You got to forget about the fundamentals, the technicals, the MACDs, the Fibonacci's, put it aside for the time being. In the end, you got the quants and you have expected move. Speaking of expected move, the SPX expected move, I talked about this on last weekend's video. Go listen to it. I told you the expected move, it's only $44. You have to also recognize that we kind of tagged both the downside and the upside this week. Now, yes, this is the SPX, but if you considered the S&P futures, we actually went down, tagged the downside of the expected move, only to end the week basically in the upper edge of the expected move. Mr. Toad's wild ride. And even after seeing that, the expected move in this next week of trade, it's about $38, which is crazy. It's crazy low. I wouldn't sell that with anybody's money. $38 expected move, you got to be crazy. You just saw, a move this week that was, $44 lower than $44 higher. And then you're supposed to tell me that I'm going to sell options and only expect a $38 expected move? There's no edge in that. There's no edge whatsoever in trying to sell premium on a week-to-week basis right now. 23 weeks inside the expected move and counting. Last but definitely not least, the financials. We've had 4 weeks where the financials, have been completely and utterly flat. Today, for the first time, we really started to see some sell-side activity as the market closed. When I'm talking about 4 weeks of the financials being flat, let me really quantify that. That's 1, 2, 3, 4 weeks. Oh, it's some holiday trade. It's nothing big. The financials, are what got us here. The financials are what got us here, and they've stalled out. Now, incoming. We've got earnings coming up in the financials. The volatility of the financials, it's elevated. Look, right there in the XLF with 7 days, that vol is all the way up to 16, 17%. This, once again, is the key sector to watch. Forget about the monsters of tech, all right? Technology, the monsters of tech, the Microsoft, the Apple, the Facebook, the Amazon, the Google. Yeah, they'll follow through, right? But they're not going to be driving that order flow. This next week, again, without unequivocation, it's going to be the financials that are out there driving the order flow. A lot to think about in this weekend's update. But the next time, again, you think, you know what's driving the marketplace, start to turn your head and think a little bit of the quants. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.